Out of over 4,000 stocks, Seeking Alpha's quant system just crowned today's company as the #1 pick in construction and engineering. That's not hype. That's cold hard data based on performance, growth, valuation and momentum. Some of the same metrics that I use in my stock scoring system. But here's the twist. The stock just dropped over 20% right after a massive new acquisition. So, does the algorithm see something that investors miss? In this video, I'll dig deep into Sterling Infrastructure's fundamentals, their business model, and the reasons for the crash, and why I think that the company might be one of the most overlooked opportunities in the market right now. And if you're new here, my name's Florian. Thank you for joining me today. Over the last year, Sterling could deliver 73% total returns, which handily outperformed the broader market despite the recent sharp drop. And over the last 10 years, this is even more pronounced. Over this time frame, Sterling stock produced around 20 times the returns of the S&P. Sterling is actually one of the first companies I've ever analyzed on this channel back in the January of 2024. In the video back then, I said that the company looks cheap despite great fundamentals and a strong outlook. And well, since I posted the video, the stock is up by over 300%. And now I ask myself if the recent crash presents a good buying opportunity for long-term investors or if the run is over. And to start, let's first look at Sterling's business model to see where the risks, but also the opportunities lie for the company. Sterling is a US-based construction and infrastructure service company that specializes in mission-critical facilities over 3 key areas: e-infrastructure, transportation solutions, and building solutions. They have a strong focus on high-value and technically very complex projects for which they partner with big corporations and sometimes also the US government. Sterling as a mother company combines the expertise of many smaller and specialized companies. So they can choose and combine the best-fitting ones for any given job. The e-infrastructure solution segment is their largest segment and makes up 43%, so almost half of their revenue. Transportation is the second biggest with 37%, while the building segment is the smallest one with only 20% of their revenue share. And that is great because their e-infrastructure segment growth is by far the quickest, while it also has the highest margins with 22% operating margin. This is also no surprise because here they focus on special infrastructure developments like data centers, semiconductor fabrications, or also constructions for e-commerce or warehousing. So they are active in many markets with secular trends. Their transportation segment, where they focus on the construction of transportation infrastructure, such as roads and bridges, but also bigger projects like ports or airports, is growing the slowest and also has the lowest margins, while building solutions, where they mostly build concrete slabs for residential as well as commercial buildings, is somewhere in the middle of these two. Overall, they could grow their revenue with a CAGR of 18% over the last 5 years. And when we look back at the numbers they had in 2019, we see that this was just the first year they started to offer the e-infrastructure services. Since then, this segment has pushed a lot of the growth and is now even the biggest one. What we also see here with the blue line is that with the transformation of their business model, their margins have also increased steadily. And in their third quarter that they reported by the beginning of November, they showed quite some growth compared to the same quarter last year again. Their revenue has still been growing by 16% in GAAP numbers, their EPS by 51%, and their EBITDA by 42%. These are all pretty insane growth rates that we usually don't find in the construction sector. And their adjusted numbers are even higher. Broken down by segment, the e-infrastructure segment was again growing the quickest with 58% even. But both of their other segments are actually showing a decline. In building solutions, this small decline came from the still tough situation in the housing market in the US. But for transportation solutions, it is a bit more complicated, which is also why the operating income in the segment actually increased by 31%. The main reason for this decline is a change in reporting of the company Road and Highway Builders, or RHB, of which Sterling holds a 50% ownership. Up until now, the numbers of RHB were included in Sterling's report, but they changed this reporting now and it is not included in their consolidated numbers anymore. The reason they give for this decision is that it modified the way that RHB could be dispositioned in the event of death or disability of Mr. Bunting, the owner of the other half of the company. So I think that they are most likely just preparing for any eventuality, but because Sterling is also known for the history of acquisitions and also divestments, I could also imagine that they are preparing to divest this part of their business in the next few years. However, their report and their official statement doesn't mention anything along these lines. To show the effect of this different accounting, I prepared a table to compare the results with RHB to the ones without. And here we see that the revenue growth is even 3 times higher when we exclude the numbers from RHB. But for me, this isn't just about the numbers. Because this consolidation also shifts the business mix of Sterling further in the direction of e-infrastructure, including the high margins there. So I wouldn't be surprised if we see the margins of Sterling rising even further in the next few years. Their backlog at least looks very good, even without considering the backlog from RHB, the grey bars here, that were also removed from their numbers. But still, the growth of the backlog, especially in the last quarter, looks very promising. Now, you might ask yourself, if everything looks so great, why did the stock crash by over 20%? And I think the reason is mainly their free cash flow. Because when we dig a bit deeper into the numbers from the last quarterly report, we see something that is suspiciously absent from the company presentation. And that is the cash flow statement. But hey, the name of this channel wouldn't be Cashflow Maniac if I would miss this. And while their net income still looks pretty good compared to the previous year, the net cash provided by operating activities and with it, their free cash flow or net change in cash is down considerably. In operating activities, this is mostly linked to a change in operating assets and liabilities, which comes from the reporting change of RHB. This is a considerable change compared to last year. But when we look down here to the cash flow from investing activities, we also see a significant change in acquisitions. This is 10 times as high as it was last year. This comes from a new acquisition, namely of CEC Facility Group, that they closed by the beginning of September. And in the announcement of the deal, we see that they had to pay $450 million in cash for this deal. So this drop in free cash flow, even though it looks quite worrying at first glance, came from accounting practices linked to the M&A activities and not from any issues with their operating business. So I wouldn't worry too much about it. In fact, it rather looks like Sterling is still trying to further boost their position in the e-infrastructure market with continued acquisitions there. And I think that this is a good idea, because this market is expected to continue growing quickly with over 10% annual growth rate at least until 2030, as this market analysis from Grand View Research shows. That is in stark contrast to the general non-residential building market, where the outlook is still pretty pessimistic. This comes from a sharp rise in costs for construction materials such as steel and aluminium that have climbed to the highest values in 40 years due to the tariffs, as Deloitte points out here. But at least the larger transportation construction market, which is Sterling's second biggest segment, is also still growing. Here, the expectation is a mid-single-digit growth of around 4 to 5% per year until 2030. These forecast numbers are also very interesting because, as we just saw, Sterling was actually growing even quicker than the general market. And this, together with the rising margins, shows that they have a quite strong position in this industry. So they definitely have a moat. But I actually don't think that their competitive edge is too huge because of the competition in the construction market and because Sterling doesn't have a true monopoly on any of their services. So a large part of the moat is earned and not embedded in the business model. And that also means that it can be lost again. So now that we understand the business, their growth perspective and the market, let's dive into the financials and also rank them with my stock scoring system. When we check my TradingView dashboard that shows the history of income numbers for many years, we see that all the metrics have been growing very nicely over the last years. Their EPS, net income and free cash flow grew from even negative values 10 years ago. So this picture shows again how well their transformation has worked out. And in my stock scoring system, they also get a pretty good overall score for growth. The only two missing metrics are the 10-year free cash flow and EPS growth. But the reason for this is not that they haven't been growing, but that these metrics have still been negative 10 years ago. So we can't calculate the proper growth rates for them. Overall, Sterling still gets 7.2 points for 5-year and 6.9 points for 10 years. This could easily be higher if we could properly calculate the 10-year growth rates too. And despite their very active M&A strategy, the company did also manage to keep a pretty clean balance sheet. This is no small feat considering the many acquisitions the company made since they started their transformation. And while their debt slowly crept up, they could still manage to keep their net debt to EBITDA ratio at only 0.12 times. So after accounting for their cash position, they still have barely any debts in their books. And their interest coverage ratio is also still at 10.5 times, which doesn't give any reasons to worry. But the company has issued new shares to finance these acquisitions. So it's a good thing for investors that they have recently shifted their focus to buying back shares. They just announced a $400 million share buyback program last week that will run for 2 years now. We already briefly talked about the margins, but I always find it easier when I can see the development in a more visual way, which is also the reason why I built this dashboard for myself. And here we see very clearly that since the start of the transformation, Sterling could manage to steadily increase their margins from very low initial levels to where they are today. And with further focusing on their highest margin segment, the e-infrastructure solutions, I can definitely see a future where this can go up even further. What I want to point out especially here is the ROIC that is with 24% quite a bit above the sector median right now. So for the health and profitability score, Sterling also looks pretty decent. Only the gross margin gets a lower score. This is still not too bad for this industry, but it's also the only profitability metrics that is actually a bit below the sector median. Unfortunately, the company does not pay a dividend. Instead, as we saw, they are using the majority of their cash for further growing the business with strategic acquisitions. And while I would prefer if they would be paying a dividend, I honestly find it hard to argue for dividends when I look at their recent success in growing their business. Dividends only make sense when a company can't find a good use for the cash otherwise, which clearly isn't the case here. In quality, I estimated the MOAT as a narrow MOAT, as explained before. And I also averaged their total secure growth to 7%. But I think that this is a rather conservative estimation. And despite their high ROIC, I only gave them an average manager quality because of the share dilution in the last years and the lack of dividend payments. But I would expect this to go up from here. Overall, this leaves them with a score of 5.8 for 5 and 10 years. The valuation and momentum score is also a bit mixed. Their recent performance was pretty good overall, but the recent crash in stock price has pushed the 52-week proximity a bit down, which affects the momentum score. But on the other hand, most valuation parameters are way above the sector medians and look pretty expensive. Only the PEG ratio that takes the EPS forecast into account looks very good again. So, despite their generally high valuations, when we factor in the strong growth, the company still doesn't look too expensive. Compared to their own valuation, it has just come down from the highest levels they had in the past 5 years. But despite this, it is still way above their own 5-year history and almost double the values that they had when I posted my first video about them. Overall, this leaves Sterling with a 5-year score of 6 and a 10-year score of 5.9. Not as high as Seeking Alpha, but still pretty good, especially when we consider that I don't yet distinguish between different sectors in my scoring. And despite the recent dip, analysts still seem to be pretty bullish on the stock. The 4 analysts that offer a 1-year price target see an average upside of 28% from today's price. This price target comes with an EPS growth forecast of 33% per year for the next 3 years and a revenue growth of almost 8%. And while both of these are just slightly below the numbers from the last 5 years, they are still pretty good. So last but not least, before I sum this up and come to my conclusion, let's also directly compare them to some peers to see where exactly they are standing in this market. And if you like the video so far, please hit the like button or subscribe to the channel to not miss the next video. As a small channel, a small like or subscribe goes a really long way to help these videos to be discovered by a larger audience. So thank you very much. For this comparison today, I, or rather Seeking Alpha, choose Stantec, Dicom, Valmont Industry, IES Holding and Fluor Corporation. And there are two companies from this group that really stand out with their performance in the last 10 years. These two companies are Sterling and IES Holdings. Sterling is actually the top performer of this group with over 6,000% total returns in just 10 years, but IES is not far behind with 4,900%. We'll see why that is in a second. Most of these companies are not paying a dividend, with only Stantec and Valmont Industry paying at least a small one. And valuation-wise, Sterling has the highest valuation of this bunch. Only the PEG ratio stands out, which shows their strong growth again. And growth-wise, Sterling really looks pretty strong. The only company that can beat them, depending on which metric you look at, is IES Holding. But profitability-wise, Sterling can beat even them, especially in EBITDA, net income and free cash flow margins. So overall, this picture shows their very strong position again. So yeah, overall, I think that Sterling is definitely worth a deeper look. Their transformation towards a higher focus on e-infrastructure came at just the right time and is pushing the company's margins and revenue growth. And despite their many acquisitions, they still could manage to keep their balance sheet pretty clean and their debt very low. Unfortunately, the valuation is not nearly as cheap as it was 2 years ago, but if the company can keep up their growth, it is probably still worth the price. At least that is what the very low PEG ratio that is actually below the sector median is suggesting. And Sterling has already showed us that they are capable of growing quickly and even beat the general market growth. The biggest risks that I am seeing right now is that the data center construction will slow down or won't materialize as expected, which would have a huge impact on Sterling. We should also remember that the construction sector is a pretty cyclical one, and the next down cycle will come eventually. But as always, this is just my opinion and no financial advice. What do you think about the company, and are you already invested? I'd be really interested to hear your thoughts down in the comments. And guys, if you are interested in another infrastructure play, this time from the utility side with 6.5% dividend yield, this video right here might be interesting for you. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.